Good evening, good afternoon, good morning, everyone who's dialed in from whichever city, whichever country that you all are coming in from. Thank you so much for joining us today. We have an amazing masterclass brought to you by Singapore Management University. And to all 40 of you and counting, if you could quickly let us know in the chat window, which city are you dialing in from? So very quickly in the chat window, to everyone who's joined today's session, brought to you by Seed Global Education and Singapore Management University. Which city are you dialing in from? So I see Aditya, Niharika, Muzammil from Mumbai. Hello. Dhruv Jain from Bangalore. A lot of people from Mumbai. I am also from Mumbai, and it's 7:30 p.m. and we are looking forward to an exciting city. Uh, Someone who's joined in from Kerala, anyone who's joined in from outside of India, if you could let us know which country you're dialing in from, anyone who's not from India or even from those in India, which other cities apart from Mumbai, Delhi, are you coming in from? We want to know which cities are all of you looking to join in from today. A very, very exciting and insightful masterclass, like I mentioned, brought to you by Singapore Management University on crisis-proofing your investment strategies for thriving in turbulent markets. Before I go into a little bit detail about that and introduce you to the panel, I am going to wait for a few more of you to join in. So once again, a very good morning, good evening, good afternoon to everyone who's joined in for today's session. In the chat window, you can let us know which city you're dialing in from. So it gives us an indication. And yes, I have esteemed faculty from Singapore Management University. I have some lovely people on the panel today from the admissions team who are going to be talking to you about studying in Singapore, your career prospects, etc. But I'm waiting for a few more people to join in. So yes, in today's masterclass, we are going to be talking about unpredictable tail risk events. So for anyone who does any kind of investment knows the tail risk events refer to events like the sudden COVID-19 pandemic or economic downturns, which can really help hurt your investments as such. So today, Dr. Wen from Singapore Management University is going to be talking to us about how using affordable options can help you protect your investments better. But before we dive into the masterclass per se, I am going to run a quick poll question, which is going to be on your screen in a bit. So for all of you who have joined in, I have just launched my first poll question for you, which is on the screen. If you could go and just answer and let us know, do you currently invest in stock, bonds, or other financial assets? If you do, then please click on yes, I invest. If you don't, then no, I currently do not invest in any financial assets. And of course, Dr. Wen will be talking about it in detail, which could help us get some insights into the market. And then maybe you start investing in those investment markets. So very quickly, once again, hi, we have someone joining us from Ethiopia. Thank you so much for joining us. Very quickly, on the screen in front of you, I have launched the first poll question for the evening, which talks about, do you currently invest in stock, bonds, or other financial assets? Yes, if you invest, and no, if you do not do any kind of investment. So if you could go ahead and answer, I'm going to keep it on for a couple of more seconds. So very quickly, to all of you in the audience, if you could go and cast your votes to this. I am going to end the poll questions very shortly. And here are the results. Wow, that's a close tie. So we have 59% of the audience which does do some kind of investment. And obviously this topic is going to be very, very relevant for you. And another 41% who does not, but I'm sure you will get some insights as to how you can go about it. So thank you so much for everyone who's voted. A quick introduction to the panel for today. My name is Sabahat Herzog. I'm the Senior Manager at Seed Global Education. We are a UK headquartered company which facilitates interactions between top global universities like the one we have today, all the way from Singapore, and prospective students like yourselves who are looking to study abroad, who are looking to get into careers abroad, giving you a chance to directly connect with the faculty, know more about their admission processes, and make informed career paths. Joining us today, we have Dr. Wen, who is an associate professor of quantitative finance at Singapore Management University and the academic director for Masters of Science in Quantitative Finance program at the Lee Kong Chian School of Business. His research interest covers quantitative trading, option strategy, market microstructure, and risk analysis. Thank you so much for joining us, Doctor, today.
Thank you, Sabahat, and thank you everyone for joining us. So I also
Thank
want
you.
to answer the poll question. So I do
Yes.
invest myself as a retail customer.
Wow.
I buy S&P index and I also invest in the stock market. I teach quantitative finance, so therefore I teach about stock price modeling. And also I'm also a hedge fund manager. I run my own quant fund. So this is a topic that is very close to my heart.
Great. Thank you so much, Dr. Wen. And we are all excited. I am talking on behalf of the participants, but even I am very excited to learn more. Along with Dr. Wen, we have Grace Lim, who is the Manager, Recruitment and Admissions at Singapore Management University. Thank you so much for joining us, Grace. Grace is
thanks,
going
Abha.
Thank you. Grace is going to be talking a little bit more in detail about the programs at Singapore Management University's admission processes. And she is the person that you need to connect with if you have any admission-related queries or questions. Along with Grace, we also have Rajneesh Verma, the Country Manager, India at the Singapore Management University. Thank you so much, Rajneesh, for joining us.
Thank you, Sabahat. Hi, everyone. Thank you for joining us on a weekday evening. Look forward to a great session.
Great. So before we get started, very quickly, everyone in the audience, please feel free to post all your questions in the Q&A box and stay with us till the end of the session to get more insights, and then we will definitely be taking your questions. So with that, I now hand over to Dr. Wen to get us started on today's masterclass.
Okay, thank you very much. Thank you also to Seed Global for giving me this platform to share about my research. So this topic is a research that I've just completed recently with my co-author, and it has just been published a few months ago in Journal Portfolio Management. It is called Crisis Proving Your Investment, but ultimately it is about tail risk management. Right? So how do we manage tail risk? Essentially, these are extreme price movement to the detrimental effect of our portfolio. So what are the things that we can do in order to hedge against these extreme price movement? Okay. For this particular research, I did it with institutional investors in mind, but there's no reason why this cannot also be replicated on a personal investment basis. Okay. So let us just get started with a very brief introduction, right? So tail risk events is something that I'm sure every one of you is already quite familiar with. It is something that, it is is quite ambiguous in terms of what exactly does it mean, but it is something that everyone recognizes immediately once you experience it, okay? It is something that is both undesirable and unpredictable, right? So no one can really predict when is it going to happen, and no one really likes tail risk. Even though there are a few hedge funds that is meant to be sort of executing tail risk hedges strategy, even for this fund, they would be upfront that you only are supposed to invest no more than 1 to 2% in their portfolio. Okay, the most recent tail risk crash is this minus 12.5% one-day move in the S&P index in March 16th, 2020. Right, so that is this crash in here. I plotted for your reference. I plotted the blue line in here is the Nasdaq index, and then this purple line in here is the S&P index. Right, so on that one day, more than 10% crash, and it is everyone experienced it, and everyone was shocked because of the COVID-19 pandemic. Sometime later in June, there was another crash, but that is a bit less noticeable, right? Everyone just remember this one day, right? The most recent memory, everyone remember this one. For this particular crash, it happens to have recovered quite quickly. As I stated it below in here, the Fed was very supportive and the US government stepped in immediately to support the stock market. So it has a very quick recovery. But this is something that you really cannot predict in advance, right? So when the crash is happening, no one knows when is it going to hit the rock bottom. So you can't really rely on that it will rebound quickly and therefore your portfolio will recover your value. So especially after this particular event, many fund managers, they were asked by their investors about what are the sort of preemptive action they have been taking in order to ensure that their portfolio is insured against these extreme price movement, right? So it really brings tail risk hedging back into the radar, everyone's radar once again. Okay. Now over here, I listed up over the past 2 decades, what are the key tail risk event in chronological order, right? So starting in 1997, we have Asian financial crisis, right? 6.87% daily loss. And at LTCM, I think this one is quite familiar to most of you, long-term capital management, one of the largest hedge fund around that time, they folded up. We have dot-com bubble, and then we have global financial crisis. So around here, there is a 10-year gap, okay? And then there are 4 to 5 events here, all within the global financial crisis era, right? So from Lehman bankruptcy to the greater fallout, to this event where the US government refused to bail out the automaker, and then US went into recession, and then Obama inauguration turns out to be one of the big market crash day also. I think that is also because that there is this inauguration of a new democratic president inheriting an economy that is in crisis. Okay? Eurozone debt crisis also propagated back to the US market. And then finally, in recent history, we have 2 COVID crash events, right? One major and then one minor, right? Both of which are quite significant daily crashes. So if you look at all of these, right, so the important thing is to realize that only COVID crash recovered very quickly. For all of the other crises, the tail risk actually sort of happen over a prolonged period, and there's no one who is able to forecast in advance how quickly is the market going to recover. Okay? So that is something that you really cannot predict, and then just convince your investors that your portfolio will very quickly recover all its value. Now, when it comes to, so this is so what I've been saying is that it is an important thing for all the fund managers to keep track of. And therefore, that also attracted a lot of researchers' interest, right? So both academic researchers and also applied researchers, they all look into this tail risk hedging mechanism. And if you look at what they have to say, over the past few decades of research, there has been a long list of academic literature on this subject. I can roughly categorize them into 3 main broad categories, right, in terms of the strategy or the approach they have taken to hedge these exposure. The first one is called prediction-based, right? If you look at this left-hand side in here, this is a prediction-based. So essentially, it is based on this premise that portfolio performance under extreme events can be predicted, okay? And the way to predict this is basically they will look at historic tail betas on the left-hand side. So you look at the distribution of your stock returns, stock market's return. You look at the left-hand side of the distribution, which is essentially the area that's constituting to all the crashes, or you look at the negative skewness in your distribution once more, and try to find some way to discern some pattern that gives you indication that this left tail extreme event is going to happen very soon, right? So that is based on the distribution profile changes, try to come up with some way to preempt and then predict that there's going to be an impending crash causing market to fall in value significantly. Okay? Below here, I listed 2 academic literature quite recent about this prediction-based approach to handle and manage tail risk. Okay? The second one is called allocation-based. I think this one is more intuitive for many of you if you look at this, because it just means that you try to optimize your portfolio holdings in order to benefit from diversification, right? I think this is one thing that we all have some intuition for. We know that you shouldn't be buying just one single stock because it is risky. But if you buy a portfolio of stocks, then you will be able to benefit from diversification, right? Sometimes the stock goes up, but others goes down. And on average, they try to cancel each other in terms of the daily movement. And they are only riding on the greater trend of the stock market, which is to gradually rise up over the long-term time horizon. So this is a diversification-based approach, right? So based on your portfolio allocation, you try to allocate it to a wider range of different asset classes like bond futures, stock market, and then also some of the other more exotic like swaps and other things, so that you can overall you get this benefit in diversification. Okay, so try to hold some low risk global asset classes, hold some gold, so hold some other rare metal ETFs, and also look at extreme value theory, conditional value at risk, in order to find the right combination to give you a very defensive portfolio combination. Okay, so that is another approach that has been suggested in the academic literature. And then the last one in here, this is also the one that is going to be our main focus today, which is insurance-based. Okay, so insurance-based means that you buy insurance in order to protect yourself against extreme market movement, essentially market crashes. Some of the insurance will be, for example, if you buy put options, for instance, then you will, when the market is crashing, then you get some payoff from the put option. The put option move into the money, and you are able to hedge against your portfolio holdings crash in value in this case, right? Option gain in value, your portfolio loses its value, and all in all, they offset each other. Other type of insurance will include things like total return swap. That is also one option. Or you might want to short some bonds, buy some credit default swaps on some countries or some large institutions. All of these are possible insurance product that you can consider that will gain in value when market is crashing. Okay, so this is also something that has been explored in the past, right? And also quite a bit of academic literature has been covering these aspects. So three main categories are listed side by side. But again, as I mentioned, we are going to focus more on insurance-based approach, because if you actually look at this problem as a hedge fund manager's perspective or any asset manager's perspective, you'll see that the first and the second approach is actually not so applicable when it comes to practical implementation. Okay? I put up some of the reasoning in front in here, right? So there's quite a bit of constraints to consider. So it's one thing to look at it from an academic interest perspective, but it's quite a different issue if you were to actually implement this strategy in practice. Talking about prediction-based approach, right? So if you try to tell your client or tell your investors that I can try to predict tail risk events, you will lose a lot of customers. That is just the reality of it, because no one can really believe, someone is able to see into the future, having this crystal ball approach to predicting stock price falling in value in this abnormal way. So prediction-based approach is interesting from an academic perspective, but it's not really something that is convincing enough. And you only have one shot, right? So that one single tail risk is enough to wipe up the entire fund. So it's not something that you can try it out for a few times and then finally get it right. So it is one time or never. So in practice, no one is really going to have much confidence in this prediction-based approach. The other one is about this allocation-based approach. It's also not genuinely speaking practical, because not as a fund manager, you are not given the mandate to invest in anything you like, right? So essentially, when you go out and attract investors to invest money with you, you have to propose an investment mandate by saying that, my fund is going to be focusing mainly in the US stock market, for example, or my fund is going to be focusing on the bond market, or I'm going to do global macro strategies or other strategies. But you have to be very clear upfront about the strategy you are running, and you are not given the mandate to go and buy some gold and go and buy some bond futures and do all of these tactical allocation just to protect yourself against tail risk. Because during normal market times, when market is doing well, none of these hedges will be performing well, and then you'll be losing out on business because your portfolio isn't performing well, since there's no tail risk or extreme price event. So this is also not something that is generally speaking very practical. Only insurance-based approach is the one that is more pragmatic in nature, right? You're trying to allocate a small risk budget. So to say that, look, every month or every year, I allocate 1% of my asset under management to buy some insurance. So 99% of my asset is still going to buy some productive instruments that is going to give me the return during normal market times. But once in a while, if there's a market downturn, then that 1% of my hedge asset holding is going to give me some protection against tail risk or extreme price movement. So this turns out to be the more pragmatic approach. And most of the fund managers, they will be following this particular strategy, right, when it comes to protecting their portfolio against tail risk event. So they try to allocate a tiny risk budget on a periodic basis to buy some insurance product, most of which is going to be doing nothing because market is not crashing. But once in a while they crash, then this will be the product that give you some downside protection. So this is as I mentioned, this is going to be the base case that we are studying. And if you think about this, right, so the most liquid insurance product that you can get hold of is actually a put option, right? So rather than doing total return swaps or other credit default swaps, these are relatively speaking a lot less liquid in terms of the market transparency and liquidity. Most of the insurance is still based on index options ultimately. So basically, let's say all of us here have S&P index exposure. So we're going to buy some S&P index put options, right? So these put options will gain value if S&P index is falling. Then this will be the one that is going to give us the protection we needed when market is falling, right? So this is the most obvious insurance product that we can buy. Okay. Now, this is the most obvious solution, and there are many funds who actually go and run these, execute this strategy. But there's some disadvantage about buying index put option. The first thing is that, no, it is true that they will give you a good downside protections during extreme tail risk event. But how many tail risk event are we expecting to see over 2 decades, right? So in the list you see just now, we have about 11 events over a 20 years time period. So it's actually not that many. Most of the years will pass by without having any tail risk event, meaning that all of the money that you spend buying these put options will actually go to waste because none of the option actually move into the money, right? So true, when the market crash, then we get a good protection from S&P index option, but most of the time market isn't crashing. So this is the downside of it, that it will exert this constant portfolio drag during more normal market conditions. So this drag is really what it means. It means that it is dragging down the performance of your portfolio because you are not using all of your assets to buy meaningful assets with meaningful return. Yeah, you're allocating some of your holdings to these put options, which is actually not productive during normal market conditions. So what we are trying to do in this particular research is to try and find, is there any way for us to find cheaper solution, right? So what about if we don't buy expensive index put options, but we go and buy something that is a bit cheaper? Will they be robust enough to give us a hedge against extreme tail risk event? And talking about cheapness, right? How do we actually define cheapness, and how do we define robustness when it comes to tail risk protection? Okay, so this is the thing that we are going to try to investigate, and we are also trying to look for some of these exploitable market behavior that is going to help us reduce portfolio drag during good market conditions, right? So is there anything that can help us, that is going to give us some tailwind in reducing portfolio drag when the options portfolio is not performing well? Okay, so that is these two questions is the one that we are trying to address in this particular work. Now, so straight away, I give you directly the result first before we go into the details of what is the research or what are the work that we have put into the analysis that we've been running. So this is the key summary of key figure summary, the whole results. So we investigate 25 years of past data, 25 years because over this period, there is there's a lot of liquidity in the option market, and then we are able to execute these cheap options hedging portfolio over these 25 years. All right. So if you look at this, right, the first figure, you look at these are uninsured index. So what this means is that this is just the S&P index without any hedge. Okay. Now you look at where it is, it's actually right in the middle, right? So you see, this is the one, I don't know if you can see this. So the one that is right in the middle is this unhedged S&P index, right? So this is the one that is going and eventually ended up right around here. That is the S&P index without doing any hedges. The second line in here, the black dash line, is the one that is insured using index puts. So what it means is that we buy S&P index, but at the same time, we buy also a bit of S&P put option, index put option. Now, this is the one that is used predominantly by many of the market participants, but this is actually a very expensive solution. As you get to see in here, they actually leads to a significant portfolio drag, and you end up somewhat, actually not somewhat, but quite significantly below without hedging your portfolio at all. Okay? So this is where you are. When the market is crashing, it is true that this gives you a very adequate or superior hedging performance, but there are only 11 tail risk events over these 25 years. The most of the time, the market is doing well. In this graph in here, all the vertical red dash line that you see in here, they are the one that says that on that day, there's a tail risk event, right? Only 11 sticks standing there. All the other times, market are doing normal or doing well. So in all of these other periods, all the money you spend buying put options are going to waste. That's why it exerted such a big drag onto the overall performance, landing the final terminal wealth significantly below, not even hedging the S&P index. Okay? But interestingly, the one that we are suggesting in here is to not buy these expensive put option, but rather go into the market and find some cheap options to buy. Right? So that is the one. We are going to define cheapness in a more rigorous sense later on. But if you go and follow this heuristic by looking for cheap option to buy rather than expensive option to buy, then you get this light blue line, which is the one that gives the overall superior performance. Right? You see that during good market hours, it doesn't really exert such a significant downward pressure on the portfolio performance because some of these options actually still make money. Some of them doesn't, but others still make money. But during market crashes, then it performs as well as the S&P put index options. So it is able to match the hedging performance of S&P index options, which is very expensive, but it is also, it doesn't exert such a significant portfolio drag during good market times. So overall, since it is good in both cases, then it combines into this overall superior performance right at the end. Right, so it's just the key message is that it works. This heuristic works. Go out into the option market, find cheap options to buy. Will give you a robust hedge against tail risk, but at the same time give you minimal portfolio drag during normal market conditions. Okay, so this is the key result. So this put up front in here. Now we're just going to spend some time to go through some of the details in how do we define cheapness and how do we define robustness, and what is it exactly that gives us this superior hedging performance. Okay? So on the higher level, maybe the insight is quite intuitive and straightforward, but once we drill down to the details, there's quite a few interesting empirical effects in the market that we are trying to exploit in order to give us this superior hedging performance. So let's take a look at this. So this is the research design. We look at these 25 calendar years inclusive. So there is quite a significant long period. And just for our categorization purposes, we're going to define all the daily downward movement in excess of -5% as a tail risk event, right? So you can define it in any way you like, but let's just define that, crash more than 5% per day, it is tail risk. Otherwise, it is normal market conditions. But even during normal market conditions, it can be going up or down. We included all of these events into our daily studies. Okay, so we formulate this portfolio of cheap put options, and this is the way that we formulate it. Every month, we allocate about 2% of the risk budget. So we spend some amount of our asset under management to buy put options, cheap put options. We want them to be robust during crashes, and we also want them to exert minimal portfolio drag during normal market conditions, right? So it is a tall orders, but we are able to do this because of a very interesting market effect that I'll talk to you about shortly. So first, let us define cheapness, right? So we keep on saying cheap option, cheap option. What does it mean to be cheap? Okay, so there are actually a few ways to define cheapness. Maybe the most intuitive or straightforward way is to just say, well, the dollar price, is it cheap or not, right? So, and this is the one that we are going to use predominantly in our analysis, right? Just look at the dollar price. If it is low, then that is cheap. Just go and buy this. Okay, so this is one of the most direct and useful measure that we can use. There are other measures of option cheapness, usually using some measure of volatility. Either you are using historical or realized volatility. So that will be the second one in here. Now you look at the past performance, look at the daily standard deviation over the past time period and see, is it high or low? That is going to give you a measure of how expensive the option will be, right, in the market. The other one is implied volatility. So this is essentially the parameter, like the Black-Scholes implied volatility. You plug into the Black-Scholes formula in order to get the option prices that are traded in the market on that day. So it is just a way for us to quote market prices. It is also forward-looking because it is the price of an option lasting for a certain time period before it expires. One other quite interesting measure that has been used in the academic space is to take implied vol minus historical vol. So then it is really trying to capture the risk premium between these two things, right? So if you take implied vol, subtract historical vol, what you get left in there is the risk premium or the volatility risk premium of the option contract. So that is also one viable measure of the expensiveness of an option. Okay? So we are going to use various cheapness definition, but we've come to see that this dollar price definition is the one that is the most useful measure to be using. Okay, and then we are going to compare the performance against unhedged S&P index, and also compare it with, against the one that is hedged using these expensive index put options, right? Okay, so this is the option universe that we are looking at, right? So we did very detailed comb through of the entire option market available to us over this 25 years period, and then we selected options with decent liquidity. So we're not going to find some out of price, unmeaningful option prices. That's why they are cheap, but none of that, right? We find liquid options that are cheap, and then we go and buy them. And then at each period in time, we look for options that have about 10% delta, put options with about 10% delta, with at least half a year left to expiry, so that there's no need for us to keep on rolling the option position too frequently, which in turn will also be quite costly. Okay, so overall, every period or every half year period, we'll be buying about 90 put options. and then they are sorted by different ways for us to rank the expensiveness of them, and then we buy 90 of them to give us these hedging portfolio against tail risk. Okay, so this is the option universe, right? We do subject it to a liquidity constraint so that we are not looking at some mispriced option in our analysis. Now, this graph in here gives us a very nice intuition about how does it perform under different market conditions. Let's start with the left-hand most part first in here, right? So this one this is the tail risk event, and the black curve or the black bar in here is the uninsured index. So that will be just how the raw index is performing. Obviously, if you don't buy any hedges, then it will give you the worst performance during tail risk event, right? That is what tail risk is supposed to mean. So tail risk, when that S&P index crashed the most because there's no protection whatsoever. But if you see in here already, it is quite interesting to see that the index put option will be able to hedge or reduce some of the losses, but not as much as the cheap put option that we are proposing to do in here, right? So if you look at the performance, right, the blue one is the one that reduces the losses by a larger amount as compared to the gray bar in the middle, which is hedging using expensive index put options. So already during tail risk event, cheap put options is the one that gives you superior hedging performance. It is robust. It is performing well. And I'll explain why is it doing well in the next few slides. Let's look at the other period first, right? What about down markets? So down market means that the crash on that day is not as severe as it's not more than -5%, but it is still a negative amount. Then this is a down market day, right? Anything between -5% to 0% will be considered as a down market day. And again, if it is a down market day, then if you have protection, you do better. So clearly, the black line, the raw index unhedged is going to be performing quite badly. And then the two of the other options will be able to give you some protections against these downside risks. Okay. Now coming up to this up market in here. Now up market, this is the part where if you don't need any hedges, right? None of these options is going to give you any money. So the black one is the one that's going to perform the best because you don't need any hedges during up market days. And here is the one you can see that this is the one that is exerting the portfolio drag. Okay, so portfolio drag means that this is the one that reduces the overall return because you are spending money to buy options, none of which is making you any money. But you notice quite interestingly that these cheap put options makes some money still, right? So the reason is because you are not buying just one option, you are buying 90 different options, some of which of them will still be moving in. So even though not all of them will be moving into the money because S&P index is increasing in value, but some of them might still be moving into the money, so still giving you some small return. So therefore, not as bad as the S&P index put options, which is going to lose out all of the options value. Okay, so that is the one. So we now have compared the tail risk event with down and up market days. Now, tail risk event, only 11 periods, right? Again, there are only 11 days with tail risk. All of the rest in here, like hundreds of them, are actually down markets or up market days. In fact, more than half of the periods are up market days because overall, in the long term, S&P index is moving in the upward trajectory. So that means that most of the time, we are somewhere within this arena. And this is the part where S&P put options being so expensive is actually leaking money away from the portfolio. So overall, if you compare the overall performance, you see that S&P don't do any hedge is actually good. Now, if you do hedges, then it's going to exert this portfolio drag. Therefore, it is lower than the S&P index. But again, interestingly, if you use cheap put option to hedge the exposure, then you see that it is actually performing as well as the S&P index. In fact, if you look at the actual number itself, it is actually slightly overperforming the S&P index, meaning that it is not doing as much drag during good market times, but it gives you a lot of protection during down market times. So therefore, doing what it is meant to be to reduce the overall portfolio risk. So this method, not only does it work during tail risk event, but it also successfully reduces all the portfolio drags. Now, this is a very busy table with a lot of numbers. Let's just look at the interesting one, right? So here, you see the top one in here. This is S&P index without doing any hedges. Return 7.2% per annum over the 25 years period. Okay, volatility 15%, right? So just look at the two numbers in front. If I hedge S&P index using expensive index put option, return reduced by 2.2%. So from 7.2% down to 5% now because of the portfolio drag. Volatility reduces by 3% because it is able to hedge the tail risk events. So it has some improvement in the volatility number, but it also returned is now compromised because of the portfolio drag. If I use cheap put options to hedge it, you notice that it is actually overperforming the raw S&P index, right? Without any hedges. From 7.2%, it goes up to 7.6%. So it not only does it not drag it down, it actually gives it some lift further upwards. And it is able to match the volatility of the hedges coming from S&P put options, which is the expensive version, right? So it is able to match the volatility of 12%, which is the one that you get from using expensive put options, but it's able to match the return of the original S&P index without exerting any portfolio drag. So that is the key results in here. And no matter how you go about doing cheapness, you can also define it using all of the other historical implied vol, historical vol minus implied vol, all of these other measures. You will see that all of them are giving you the more or less the same volatility measures and more or less the same return of 7%, right? So that is actually, if you use cheapness as the heuristic to choose a portfolio to hedge your tail risk event, then it is going to give you an adequate hedge during down market times and also giving you very minimal portfolio drag during normal market hours. Okay, so it works very well in terms of return, in terms of volatility. Then it extends also to Sharpe ratio, Sortino ratio, however you want to define your return performance benchmark. Right? It is performing very well because it is something that works very, very nicely. So maybe let me just spend a little bit of time to just finish it off by giving you the intuition behind why does it work so well. Okay, so what is the reason for this robustness and what is the reason for this outperformance? So essentially it boils down to the way that market correlation behaves. So this is the magic parameter, like correlation inside the market. How does it perform? Now we tend to think of correlation as a static number. At least that is what we usually learn in an introductory finance course. We think of correlations is a one number, right? So this is the number, 20% is 20%. But correlation is actually market dependent. It means that when the market is crashing, correlation is one number. But when you have a bull market, correlation is another number. And this is the intuition. When the market is crashing, right? So when market is bad, correlation always spike up because everyone dump their portfolio at the same time, right? Everyone needs cash, everyone dump it at the same time. So therefore, everything move in the same direction, correlation shoots up to 1. But when market is doing well, then everyone is doing different thing, and therefore correlation will start to drop. So in short, correlation is always higher when market is falling, and it is always lower when market is rising. Now, this is the effect that gives us the superior hedging performance. You see in here, right? So here I have 11 tail risk event. Now, index return is -7%. This is the one that is unhedged. Now, correlation among the put option is 65%. Now, it is quite a high number, right? And in other measures, it can go as high as 70%. Now, this 70% means a lot of things because remember, we are buying 90 options in here, right? 90 options of different equity or different stocks, and we just select them according to how cheap they are. So we buy 90 options of different equity names. If the correlation is high, it means that all of them are falling at the same time. So if all the equity are crashing, then the put option increases in value together. That's why this high correlation gives us the robustness we need, right? So we buy 90 different options. They all move into the money at the same time during market crashes, and that is what gives us the hedging performance during crash time. During down market times, and there are 100 periods of down market times, correlation is about 50%. We look at the overall number, it is about 50%, which is still quite high. So that is what gives us the good performance also when market is falling marginally, but not as bad as this tail risk event. And then finally, when it comes to good market times, right? Okay, so good market times in here. Now there are almost 200 events or 200 periods of good market times, and correlation fall as low as 40%. Now, when correlation is only 40%, among these 90 options, some of them expire worthless, but others move into the money. So this is the advantage of buying a few options rather than just buying one single index put option, but do a lot of it. So here you get to benefit from diversification essentially. Some of the stocks goes up, but some of also go down, and the one that goes down makes the put option move into the money, and you exercise it, and therefore still getting some payoff from the put option. Okay, so this is actually the effect that gives us the reduced portfolio drag effect, right? It is the same effect that correlation spike makes all the put option move into the money together. Therefore, it is robust during tail risk. But when market is doing well, the correlation is a lower number. So stocks do different things. Some of these put option move into the money. Therefore, it reduces portfolio drag overall. Okay? So this is the key effect that is giving us this superior performance when compared to using these expensive index put options. Now, I have a few other slides at the end here. So these are just some of the extension that we can consider. So let's, I'm not going to spend too much time on this. So what we have seen just now in the results so far is based on a monthly rebalancing cycle. So that means that every month I will do the options, and then after that, I'll look at the end of the month and see, do I need to do any rebalancing, or do I need to exercise some options, and so on. So it is done on a monthly, month-end basis. Now, what it says in here is that there is actually some room for further improvement if you do active tail risk management by early exercising some of the options when they move sufficiently deep into the money. Then you can actually further improve the performance of your hedging portfolio. Right. So here, below that, we can see that you can get some marginal benefit by exercising early your put option. So there is still room for enhancement in the overall hedging performance. Okay? So there's still room for further improvement. And then finally is the cost, transaction cost analysis. So this one is, we have to put it there because it is a practical paper. But what we find is that it is fairly robust, right? But if you put this, so let's not go into too much details in here. But if you are able, you are still overall paying for about 30% of the transaction of the bid offer spread. It is still able to give you outperformance compared to index options, the expensive version. So it means that this is a robust strategy that is actually practical in nature, right? Even if you pay an expensive bid offer spread, it is still cheaper than buying expensive put option. Okay? So this is we have done some of this analysis just to be sure that this is not something that is only working in theory but not really working in practice. So let me just wrap it up. Right? So this is the overall summary of this piece of work. Is that it is quite a surprising thing, right? We find that you just buy a portfolio of cheap options, and then already it gives you a robust hedge against tail risk event. Okay, and then it's comparable in hedging performance to these expensive index options, right? The one that we have just seen earlier. And then we investigate further. What is the reason behind this superior performance? Right? We find that it actually comes from the empirical behavior of market level correlation, right? So when market is bad, correlation spikes up, therefore providing the required hedging return, right? We buy 90 options, and if correlation is almost 1, then they all move into the money together, and therefore the hedge is robust. But during normal market conditions, correlation is generally lower. And in this case, some of these options will still move into the money, but index options will not move into the money. So therefore, this is the one that mitigate the overall portfolio drag. So we are riding on the empirical market level correlation behavior in order to give us this superior performance during down market time, and then giving us minimal portfolio drag during up market times. Okay. Now, if this is interesting for you, which I hope it will be, because I find it very interesting when I did the research, and it is also something that is very close to my heart, this entire option market thing. If it is interesting for you, you can actually find the entire paper available for download in this link below. Okay. Okay, let me stop here. I've used up my 30 minutes. Let me pass the time back to Sahaba.
Thank you. Thank you so much, Dr. Ven. That was really insightful. If you have the link with you, it would be great if you could share it in the chat window so
Yeah,
the students can also access it. So thank you so much, Dr. Ven. You can stop your screen share now, because I am going to quickly move into the next bit. I am sure all 200 of you have found this session very insightful. You'll have got to learn a lot more. I see quite a few questions in the Q&A box, but I would request you all to wait a little bit more, because I am going to have Grace come on in a bit and explain a little bit more in detail about the programs. But before that, I want to run my second poll question for the day for everyone out here who's looking at applications. So I am very quickly, 1 second, sorry. Okay. I am trying, okay, hold on. Right, I'm going to stop sharing this. Great. And we are going to go back. Yes, so I'm going to launch my second poll question for the evening for all of you who are in the participants window. My second poll question for this evening is on the screen. Are all of you looking to apply for the fall 2024 intake? Your options are yes, you've already applied, keeping your fingers crossed, hoping to get the best results. Not yet, because you have been procrastinating. You want to know a little bit more about the options available for you before you go ahead and you are applying at later intake. So to everyone in the participant window, if you could quickly go and cast your vote and let us know which intake are you looking at, where exactly are you in your study abroad journey, that would be super helpful. In the meantime, Dr. Wen has been kind enough to share the link in the chat window so all of you can access it. Please copy paste it, keep it handy so it's useful. I am going to quickly end this poll question. So if anyone still wants to answer, please go ahead and cast your votes. We are going to be ending the poll question very, very shortly. Thank you. So with this, I'm going to share the results on screen. 41% of you have said that they want to know a little bit more about their options before you apply, which is right. Of course, you want to check out what's available for you out there. 31% are applying for later intakes, and 22% of you have already applied for the fall 24 intake, which is great to know. Thank you so much for everyone who casted their votes. With that, without further ado, I now hand over to Grace. Grace, if you could take us through your presentation and let us know a little bit more about SMU.
Yeah, thanks, Abahat. Okay, and thank you everyone for joining us, this evening to know more about, to hear about the masterclass from Prof. T, as well as to hear more about our finance master program that are offered in the Singapore Management Universities. So today I'll be sharing more about two of our programs, which are namely the Master of Science in Applied Finance, also known as the MAF, as well as the Master of Science in Quantitative Finance program, also known as the MQF program. I will quickly run through the two programs and then we can take questions at the end. Okay, so before that, let me just share a bit more about our school. So we are a pretty young school. We established in the year 2000. We modeled after the Wharton School, University of Pennsylvania. So this year it's actually our 24th anniversary. And we are the Lee Kong Chian School of Business. We are the flagship school of SMU. And currently we are also the largest business school in Singapore. So in view of our business connections and network built over the years, we also have good employment records that were achieved by our graduates. And currently we have the biggest network of business connection in Singapore. So within, around the Asia region, we actually have around up to 2,000 connections with the companies all over this Asia region. So if you are to join SMU as a student and afterwards as an alumni, you will also have access to all these connections and network that will be offered by the school, as well as access to all our resources. So over here are some of our recognition gained over the years. We are actually Triple Crown accredited. So Triple Crown accredited, namely the AACSB, American accreditation body, as well as the Association of MBA. So this is associated to the MBA program, as well as ACRIS, European accreditation body. Among specialist universities, we are also ranked 15 by the QS World University Ranking in 2024. And in terms of research, we have also done pretty well. We are ranked first in Singapore, second in Asia by the University of Texas at Dallas. So in specific for our applied finance program, we are actually ranked 5th among Asian business schools and 41 globally by the Financial Times Master in Finance Pre-Experience ranking in the year of 2021. So as a student of SMU, you will be able to experience a very different kind of classroom environment. So we conduct our classes by a seminar style of learning. It will be very interactive, and our class sizes are kept small because we want to encourage the flow of learning between you and your peers, as well as you and the professors. So in classes, you can expect to have a lot of classroom participations, classroom discussions, group projects. This will also allow our students to enhance on their soft skills that will be very much required for the corporate world after you have graduated from the program. So firstly, I will share more about the Applied Finance program. So if you were to join this program, you will be able to leverage on the experience and expertise of all our faculty members. And some of them, they do have like many years of industry experience before they join SMU as full-time faculty. And for our elective modules, there are actually a lot of our elective modules are actually conducted by adjunct faculty who are actually currently still working in the market, and they will be able to bring more market insights to you when they are sharing classes. And through the MAF program, there will also be an internship opportunity. So students will be able to make use of this internship opportunity to gain real-world experience through our network of more than 3,000 companies worldwide. And for the MAF program, we also offered some specialization tracks, which I will be covering them in a short while. And for the MAF program, something special about this program, we are actually a collaborative partner of CFA. So for students who are looking to pursue the CFA certification, this program will be a good form of preparation for you to prepare for your CFA certification up to level 3 in terms of the curriculum. So over here is the program calendar of the Applied Finance program. This is actually a 1-year program. And after the 1-year program, if you were to choose the internship segment, it will be a 4 to 6 months internship. So it will be 18 months in total. So there will be a total of 9 core modules, 4 elective, and 1 open module. So for the open module, it will be for the students to choose among an internship, a capstone project, or another MAF elective. So this is the next intake will be in August 2024. So for students who are looking at the upcoming intake, later I will be sharing more about the application timeline. So at the start, you'll be taking your core modules. So the core modules are meant to build up on your financial knowledge before you move to specialize with your elective modules with the specialization tracks. So these are the core modules that all students are compulsory to take. And for the elective modules, it will be categorized into 3 main specialization tracks, which are namely the fund management, fintech, and real estate. So if you are interested to pursue one of the specialization track, you will need to choose 4 elective modules within that specialization track. And this specialization will be indicated in your transcript. But in any cases, if you would like to keep your options open, it is also possible for you to mix and match across the specialization track. So this specialization is not something that is mandatory. So students have the flexibility to choose what kind of elective you want to pursue. So going back to the program calendar, so in fact, in terms of curriculum, let's take a look at the full-time intake. In terms of curriculum, after students have completed study term 1, one study term is about 3.5 months. So after students have completed study term 1, in terms of curriculum, students are actually prepared to take CFA level 1. So this can help you to prepare and take note of the timeline accordingly. Okay, next up, I will move on to the quantitative finance program. Over here are some key program highlights, quite similar to the Applied Finance program. In fact, they share a similar program calendar as well. So in terms of career prospects, 8 out of 10 MQF students managed to secure an employment within 6 months upon graduation. And in terms of specialization tracks, the MQF program also offers their other 3 specialization tracks, which I will be sharing in a short while. So here is the program calendar of the MQF program. The MQF program actually offers 2 different tracks, the SMU track and the international track. But for both tracks, it's actually a 1-year program and inclusive of a 4 to 6 month internship if you were to choose the internship segment. So for the SMU track, it will be fully conducted in the SMU campus, so fully conducted in Singapore. As for the international track, students will be spending their study term 1 in Singapore. And for study term 2, students will be going over to Base Business School in London. And after that, you'll be coming back to Singapore again to complete your 4 elective modules. So at the start, you will similarly be taking 9 core modules. So the core modules are meant to build up on your quantitative financial knowledge before you move on to specialize in your elective modules. So for this MQF program, as compared to the Applied Finance program, definitely it will be more technical and programming will be involved. So in fact, for this program, Python will be the main programming language that will be used throughout the program. And it will be good if students were to join the program with a bit of programming background, as well as if you have a strong foundation in mathematics. So this will help you to adapt better into the program as well. So for the MQF program, the 3 specialization tracks are namely financial data science, algorithmic trading, as well as risk analytics. But similarly to the applied finance program, the specialization is not something that is mandatory. So students can choose to mix and match if you would like to do so. But if you do have a specific area of interest and a specific career aspirations in the future, you may want to pursue a specific track so as to have the specialization indicated in your transcript as well. So I would like to share a bit more about the international track. So this is actually a joint degree that's offered by both SMU and Base Business School. The tuition fee is exactly the same for SMU track and the international track, and students will be spending 3.5 months over at London. So if you are someone who is looking to gain international exposure, as well as to look for international opportunities, this track may be something that you would want to consider, because after graduating from the program, you will be able to have access to all the network as well as career resources by both universities as well. And if you were to join this track, there are actually 3 additional modules that you can choose from: the quant trading, advanced stochastic modeling, as well as advanced simulation methods. Okay, so over here is a comparison table to compare between the 2 programs. So for the applied finance program, it really helps you to have a better understanding of how the whole finance industry works, as well as have a holistic view of the finance value chain. And for the quantitative finance program, it's a detailed studies of statistics. It helps you to understand in different areas like pricing and hedging, risk analytics and management, as well as quant trading. So depending on your area of interest, as well as your career plans in the future, be it short-term or long-term career plans, the different programs you may want to compare whether like how do you see it helping you, how do you see it adding value into your career after you have graduated from the program. As for the students who are looking to pursue the 2 programs, it's actually quite similar. They actually have quite similar profile. We do see a very diverse cohort of students joining the 2 programs. So different type of student profile includes fresh graduates who have freshly graduated from the university. They are looking to pursue a master program to help them to understand better about the corporate world, or finance professionals who are looking to have a boost, have an upskilling in terms of their financial skill sets, or even like candidates who have been working in the industry, different industry, out of finance field for a few years, and they are looking to career transit into the financial field. They may also make use of the program to help them to do the career pivot into the financial field. Okay, over here are some of the career opportunities that are achieved by our past graduates. So for the applied finance and quant finance, because of the difference in terms of the curriculum as well as what the program can provide to our students, the kind of career opportunities can be quite different as well. So as you can see, for a quantitative finance program, it's usually more in the trading role, hedge funds, risk analytics kind of role. And for the applied finance, it will be a very more general role, different kind of industry. It doesn't mean that the applied finance does not cover any quantitative finance curriculum, but rather it depends on what you're looking for from the program. If you would like to have more technical knowledge, or do you want to have more general knowledge? So you can compare accordingly. And over here at the bottom is some of the companies who have hired our graduates in the past cohort as well. So over here show a screenshot of our alumni who have graduated from the past cohort, and like their achievement after they have graduated from the program, and like their current profile in the different finance industry. So depending on the cohort that the graduates have, the alumni have graduated, some of our alumni have actually who have graduated in the earlier years, they're actually in a more senior profile right now. And we do conduct like networking events from time to time. So if you were to join us as a student, there may also be opportunities for you to interact with the more senior alumni, and they may be in a hiring capacity that may be able to offer you with an internship or even a full-time employment role. Okay, so in SMU, we do also have a postgraduate career service team that's dedicated to our postgraduate students. So once you're admitted to the program, there will actually be a career coach assigned to you. And this career coach will be able to work closely with you in terms of career coaching, career mentoring, and help you to refine on your CV, help you with some mock interviews, basically help you to enhance on your employability. So from time to time, there will also be career training as well as career workshops for our students to enhance on their soft skills. That's very much required for the corporate world. So all in all, I would say that the career service team is here to help our students, but our students, I mean, this must be a very mutual kind of relationship. So our students, just to let you know that all these resources are available and you can reach out to all of them after you're admitted as a student, but you will need to know how to make use of them as well. Okay, next, I will want to share more about the admission requirements. So this applies to both our programs. So to apply for the program, minimally, you will need to have a bachelor degree in any undergraduate field from a reputable institution. So we do not only limit to finance graduates, but in fact, we do, in our past cohort, we do see a very wide variety of students applying to the program, coming from like business background, engineering background, applying to the different programs. So along with your application, we will need a copy of your CV as well as 2 essays. So the essays is to let us know like why do you want to apply for this program, and also like how do you see the program helping you in terms to achieve your career and personal aspirations. 2 referees will be required. So in your application form, you will need to provide us with their contact details. And after you have submitted your application, an email will be automatically sent to them for them to complete an online referee report, which will take them about 5 to 10 minutes. Admission test will be required. So the admission test can be taken in the format of GMAT or GRE. But if you have not taken any of these, you can also choose to take our SMU admission test. So in the next slide, I will also be sharing more about the SMU admission test if for the interested candidates who are keen to take that. So for undergraduates, for students whose undergraduate studies were not conducted in English, a TOEFL or IELTS will be required as well. And after all your documents are in and you have cleared the requirements for the admission test, we will be scheduling you for an interview to find out more about your profile. So the interview will take about 20 to 30 minutes. It's an online interview, and it will be asking you more about how do you see the program, how do you see the program adding value into your plans, as well as your possible contribution into the cohort if you were to join as a student. So over here is a more detailed sharing for the SMU admission test. So this is an online test and all the questions are in multiple choice. This test will take you about an hour. So this test is actually break down into 3 different segments: the verbal, numerical, and inductive. So for the verbal part, you'll be given some passages to read. And in the questions, you'll be given some statements for you to analyze which one is the most accurate according to the passages that you have just read. So as for the numerical one, you will be given some tables and some charts to analyze. And in the questions, you will be asked to choose like the most accurate set of data according to the charts. And in terms of inductive, you'll be given a series of diagrams. And in the questions, you'll be asked to like find out the logical patterns accordingly. So for our application process, I would say that it's quite fast. So the whole application process from the point that you have submitted your application to the point that you could possibly receive the admission offer, it will take you about 2.5 to 3 weeks. And also we practice rolling admissions. So if you are keen to join the August 2024 intake, I would really encourage you to put in your application early so that this will give you a more competitive standpoint from the scholarship perspective. So do work closely with us as well. Work closely with the admission team if you were to join the August 2024 intake so that we can help you along the way. Over here are some of the finances that's applicable to the August 2024 intake. To apply for the program, there's actually an application fee of $100. But for this, we can help you to waive it off. So work closely with us on your application. For the SMU admission test, it is priced at $125 per attempt. For the tuition fee for the upcoming intake is $54,500 for both programs. And the registration fee will only come into place when you are accepting the offer. So this amount is only required when you want to accept the offer. So all these amounts are actually indicated in Singapore dollars, and also they are inclusive of government taxes. We do also provide scholarships to help our students with their finances. So scholarships can actually cover up to 30% of the tuition fee, and there are no bonds attached. So there are actually different kinds of categories of scholarships that students could possibly apply, and depending on your profile. So if you would like to understand more about the different kinds of scholarships, do work closely with the admission team once again, so that we can advise you what scholarship may be applicable based on your individual profile. So over here are some of the application timeline. So currently the admission cycle is ongoing for the August 2024 intake, and the deadline will be in May 2024, so that students are in time to apply for the student visa. So I do see some questions that are asking about the student visa. Maybe I can touch a bit now as well. So for student visa, the school will be helping our students with it. We will be providing you with more information during the matriculation period, so that students will know like how can you apply for the student visa. So basically the application of the student visa will take place around June to July, so that it gives students enough time to apply for it and also to be able to start school in August. So over here are some of our email addresses and the application link. Later I'll be sharing in the chat box as well, so that you can have a more detailed look through it. And also I would like to share that we do have some upcoming coffee sessions in India, and this will actually be, if you were to join our coffee session, you'll be able to meet our country manager, who is Mr. Rajnish. He's also here with us today. So later he will be sharing the links in the chat box as well, so that if you would like to join us for the coffee sessions, you can register via the link.
I just
Okay, I
shared
think
for
that's all.
Bangalore. Let me also post the coffee session link for Mumbai. Yeah. Thank you, Grace.
Yep. Thanks, Rajnish. Okay, I think that's all from my end. Sabahat, do you want to take over first?
Yes, thank you. Thank you so much, Grace, for the wonderful presentation and taking us through all of the details of the services offered by SMU. You can stop your screen share now. Rajneesh, thank you for sharing both the links in the chat window. The students do have access to it, and I would encourage them to attend and meet you in person and get to know a lot more about the university. Well, we have sort of exceeded the time limit, but I do want to take a couple of burning questions which are in the Q&A box. So very quickly, of course, like you rightly mentioned, Grace, starting with you, there were a couple of questions around scholarships, around visa processes, which you did speak about. So, and I did click on the answer button when you were doing that. So I'm hoping those students have gotten some insights into the scholarships as well as the visa processes offered by Singapore Management University. Grace will be dropping some details in the chat window as well. You can definitely reach out to the team there and work on that further. I will take my first question for this evening. Dr. Wen, this one is for you from Akshay. His question is, nowadays we are seeing that top global economies are falling into recession. I mean, just this morning there was news about UK going under recession. Japan has recently declared that they have gone into recession. And even the US markets are rising despite the recession fear. What are your views on this? Is this a huge bubble that people are missing? What is driving the markets that keep rising towards a new high and then suddenly dropping?
So I think for the US market, because it happens to be the largest market also, so there's always going to be certain amount of some degree of US exceptionalism, perhaps because of the size of it, and also because of the dominance of a lot of these tech companies in there. They are still innovating, so there's still a lot of new things coming out from their companies. Now, one could argue that it is some of them are overvalued, but there's still this stream of new products coming up that you can see the source of innovation and a string of new ideas coming up. And anyone who wants to get hold of an equity market exposure, they immediately think in terms of the US market because it has been to be the biggest one and also the one that has a lot of originality and creativity. So because of both the size and the amount of new ideas coming out in that, there will be some degree of exceptionalism. Many have argued also that it is a dark bubble that should have been bursting soon, but it has been a few years running already. This argument has been sort of rolling down the road for quite some time, but it hasn't really burst yet. There might be a small correction, but perhaps a big crash is at least not within the time horizon. Who can tell? But it doesn't seem like it is significantly overvalued at the moment.
Thank you so much for your insights, Dr. Wen. Akshay, we hope that answers your question. I'm going to take my next question, which Grace, Rajneesh, one of you could answer. There were a couple of students in the chat, in the Q&A box, who've asked whether there are any courses or any of the finance related courses which someone with a marketing experience can pursue. So to elaborate the question a little bit more, if you could speak about the admission criteria, in the sense that do you accept, what are the fields or undergraduate study areas that you accept students for who are looking to pursue any of your finance courses?
Okay, maybe I will take that question.
Yeah.
So to start off, I would say that when we are assessing our candidates, we look more at their motivation as well as their career aspirations. So we want to understand like how they see the program, like the different programs, helping them to achieve that. So it really depends. I mean, this really depends on like what are you looking for from a postgraduate program after all. And also like do your research about the two programs. And then, I mean, if after you have done your research, if you have any questions, then reach out to us so that we can advise you accordingly. But first of all, you need to understand like what the different programs could possibly provide to you. And after which you need to see like which one is more aligned with your career plans after you have graduated from the program. To do here is really to match you to a program that would really help you after you've graduated. As for like whether do we find a specific undergraduate study that the students are coming from, I would say no particular one, because based on our previous cohort, we do see like a very wide variety of students applying to the program. And some of them, they are not either from the financial field, they are not from the engineering field, but it's also still possible depending on their motivations, depending on maybe other certification that they have obtained over the years, things like that. It really depends, because like this is also why that we have the admission test as well as the admission interview put into place, so that it will allow us to understand better about the students in terms of their academic capability as well as their motivations through the admission interview. Yeah,
Great.
I hope that answers this question.
Yes, it does. So to summarize it, anyone not particularly coming from finance or engineering, if you are aspiring to pursue, do a post-graduation in finance, and if you have the right kind of attitude and aptitude for it, yes, you can apply to Singapore Management University. Make sure you have the right qualifications which are required to fulfill the criteria, but feel free to go ahead. Great. Thank you so much, Grace. Dr. Wen, sorry. My next question is from you. This is from Srivastav, who wants to know, my question was, in your experience as a hedge fund manager, which strategy has generated the highest alpha for your fund? And his follow-up question is, what is the average slippage you would be facing on long dates option?
So in my case, I think I can only speak from my own personal experience, and strategies are very specialized. So our fund, the fund that I run with my co-founder, is a volatility arbitrage fund, and also managed futures. So these are the two main strategies that we employ. So both are either directly trading options straight away, or using option market to generate trading signals, so that we can then apply it to a managed futures positions. So it is trading intensive, and it is based on option market, doing volatility arbitrage. So that's the one that I'm familiar with. Other funds might be doing global macro or other type of approaches, which will be different from the approach that we are taking. So it's quite specialized. We need to spend more time looking into the things that we are doing to improve the alpha. So I can't answer for what other strategies other funds are doing and compare that in this objective way.
Okay. Thank you so much. Yeah. Thank you so much, Dr. Wen. Srivastava, we hope that gives you some insight into this. I know we have exceeded the time limit, but I'm going to take my one last question for this evening. Grace or Rajneesh, one of you could feel free. There is a student who wants to know, what are the career options post-graduation from SMU, particularly for an Indian student who is looking to, let's say, pursue a master's program from SMU? What are the career options for them work-wise? And is it easy for them to, let's say, get work visa in Singapore to further advance their career there?
Okay, I can take that questions. So if you were to ask me about like the employment statistics for the past cohort, actually, in fact, for both of our programs, almost 90% of our graduates managed to secure an employment upon 6 months after graduation. And most of the offers that they have received, I mean, most offers are actually located in Singapore. So I would say that this really depends on how you build up your profile during your time of study. Because now for both programs, they actually includes the internship component, so that students could actually possibly make use of the internship component to maybe convert yourself into the full-time employment, and also make full use of the career resources that are available in the school. For example, your career coach, for example, all the career workshops, as well as the career fairs, the networking events, as well as like the career portal, things like that. Make full use of all the career resources. And also like networking events, if you are able to meet all the different industry professionals, I mean, try to network around. So it really depends on how students build up their profile along the way, and then like how the school could possibly help you to refine your profile along the way as well.
Great, great. Thank you. Thank you so much, Grace. I had said that this would be my last question, but yes, one more final question. Something that, always comes across with undergrad students. They always want to know, how much does CGPA matter? Like, what is it that their undergrad scores, how much of a role they can play? So just to, since we're taking this question, just to broaden it more slightly, what would you say are the aspects or the components that you look for any applicant from India who's applying? Are you looking at CGPA? Are you looking at their resume? Like, what would be an ideal candidate profile for applying to any of the finance programs at SMU?
Okay, for CGPA, there is actually no hard requirement in terms of the CGPA, because our students will be coming from different university after all. Yeah, and also all around the world. So it's very hard to have like a gauge for the CGPA that's required. This is also why we have the admission test put in place, so that students will be put on the same scale. Yeah, so depending on your profile, you can either choose to take the GMAT, GRE, or the SMU admission test. So as long as you meet the requirements, and then we will be able to schedule you for the interview. And then the interview is for us to understand more about your profile. And ultimately, we look more at your motivations. And also, like, I mean, we may look at your transcript as well. I mean, to take a look at your, maybe if you have taken finance module before, or you have taken specific modules before, we may take a look at that. But I would not say that in terms of admission requirements, we have a specific CGPA that we look at.
Okay, great. Thank you. Thank you so much. Mukesh, we have covered this question. I will share the recording with everyone. Later, we all will be able to go through all of this in detail. But I would have to end the session now, since we have already gone over our time limit. But thank you so much, Dr. Wen. It was an absolute pleasure to have you, Grace, and Rajneesh, all three of you join us and talk to us so much more about SMU, about Singapore as a whole. To everyone in the participants box, thank you so much for joining us, for sticking around, for being part of this wonderful session. Quite a few links have been posted by my esteemed panelists here in the chat window. Please access them and make use of them. And we look forward to seeing you. So thank you and good night to all of you.
Thank you, Sabahat. Thank you,
Thank
and
you.
good night to everyone.
Good night. Thank you.
Thank you, everyone. Bye.
Bye.
Thank you, everyone. Good night.
Thank you. Good night.